all of these things had massive headwinds, retail as well, just, a lot of change in e-commerce. Industrial was interesting. I think that was a great space, but crowded. There's a ton of people there. So to me, this anchor of residential, which was an asset class I knew really well, and focused around this like sort of newly emerging vertical, which the growth dynamics in that space are incredible. And all it takes is small adjustments in home ownership nationally from that like 66 historical to 64 to 63 to 62. And this sort of institutionalization of the built-to-rent sector, there's massive tailwinds for growth.
This episode brought to you by Suites at Madison. Meeting and conference rooms for rent by the hour, week, month, or year. Suites at Madison, where business gets done. Check them out at www.downtowntampaoffice.com. Now, on to the show.
You are listening to the Invest Florida Real Estate Show, covering topics in lending, buy and sell strategies, property management, hot markets, and tips and tools to guide you along the way on your path to real estate success. You want Florida investment real estate talk? You have come to the right place. And now, our hosts, Eric Odom and Steven Silverman.
Hello and welcome to another episode of the Invest Florida Real Estate Show. This is your co-host, Eric Odom, along with Steven Silverman. Steven, we got a lot of feedback on this insurance situation on the podcast that we had a couple episodes ago. Obviously, insurance is a big problem in the state of Florida. I really wish our legislators would have been paying more attention to this. They're kind of asleep at a wheel, and it's gotten out of hand. And we're starting to lose tenants over this because they falling off the edge of the financial cliff. They're getting hit with taxes and then this insurance, and the insurance just doubles and doubles. Taxes going up, property taxes, 10% every year. It's too much. And you have the increase of cost of goods for these small businesses. It's just pushing the weakest ones off of the cliff. And I really hate to see that. It's one thing if the market consumes a tenant and their product or service is not viable to the market. It's a whole different thing when it's completely able to be controlled by the government. And tax and insurance, in this particular instance, it is. They are.
Yeah. So listen, what you're saying is absolutely right. I mean, in Florida, the average commercial increase in insurance year over year is 40 to 50%. And there's some properties who went up 200%. And how do people manage with those things? Part of the reason is there's this perception of black swan events, like one-time events that nobody predicted, hurricanes, floods, all those kinds of things. Those are part of Florida. And the way Florida is located, probably, I think I read that 8 to 10% of all insurance claims happen in Florida. But there's another reason Florida had like huge insurance increases. 80% of fraudulent claims actually happen in Florida. And what it was is all, attorneys working together with roofers and going after insurance companies. And it was just unsustainable. Many insurance companies left our market and it was looking pretty bleak. But lately there have been some changes, right? Which will take some time to take effect. But I think the most important one is in May this year, they passed legislation for the assignment of benefits. That is abolished. A roofer or a homeowner can no longer assign his benefits to somebody else, because that was a huge part of the fraud. The other thing is the time to file a claim. It used to be 3 years. After 2.5 years, suddenly people would start filing claims because they'd hear about neighbors and all those things. Now it's reduced to 1 year. So that'll take some time to kick in because, it's retroactive. All the actuaries are going to look in the rearview mirror to see that the markets calm down. But it should help over the longer term mitigate these increases in insurance. At least it's one
piece of it.
Bright, one bright spot.
Yeah, one piece of it. I mean, it's been tough, and we manage properties as well as brokers, and our solutions are, we'll help buy properties for folks. And then if they want, we'll manage them as well from soup to nuts. And so, we've a number of our properties that we've purchased and then leased up, the bottom end of these tenants are starting to struggle a lot. And I really hate to see small businesses being put down by things that are not just out of their control, but they are controllable. And that's really what's occurred here. Some of these items were completely avoidable, and here we are. And so they're having to absorb these costs, and it's tough for them. But Stephen, we get by with our listeners, right? They're the ones who keep us.
We get by with a little help from a friend.
By with a little help from our friends.
As long as you don't sing it, Eric, I'm good with it.
I have no intention of singing. Even if I were to sing, it probably wouldn't be called singing, maybe caterwauling or something. But, we ask our listeners, if they've not already, to leave reviews for us, because the reviews do help us a lot. It takes a lot of time and energy to program this show. You might find it surprising that not everybody's just jumping out of their chair to come spending 45 minutes or 30 minutes with us. So it's tough. It's tough for us to try to get folks that will come on and provide relevant information, interesting information for you guys.
Well, good and qualified folks, not
just anyway.
There's lots of people who'll just talk, right? But we want to get qualified information.
And look, there's lots of podcasts out there. I mean, Bigger Pockets, for example, one of the biggest podcasts in terms of listener base. They cover all sorts of things in single family home and some small multifamily and that type of investing, the soup to nuts, how to find deals, market deals. And we do some of that too, but that's really not our bread and butter. There's plenty of podcasts that cover that. We cover the state of Florida. Everybody that we bring in, we want to have them have some tie to the state, and then we can talk to them about what is going on and get some idea and some feedback in the local markets. And I think that's really what makes our podcast a little different from every other real estate investment podcast that's out there. And there's literally hundreds of them. So we understand that. You could invest your time pretty much anywhere. You'd have to specifically want to come to listen to Florida content, but that's what we look for. And so it is tough for us to program. We try to find relevant information. We just don't ask anybody. But having said that, wanted to thank Mary Bird. Left us a review, Stephen. It's always great when we get the reviews, particularly when they're not criticizing us.
And she didn't mention your singing.
And she didn't mention singing. And
okay.
And,
all right, I'd love to hear the review.
You want to hear the review?
Yeah, I'd love to hear it.
Do I also get to read the
because I never paid her. Usually I keep careful track of her.
Usually your relatives. They're your relatives sending, hey, Eric, quit being so mean to Stephen.
Yeah.
Okay. So anyway, Mary Bird says, fantastic podcast for all things Florida real estate. I've been listening for a month or so now, and I have to say the content that this show produces is not only high quality, but very diverse in the topics around commercial real estate. I've been looking for a Florida-based commercial real estate podcast for a while now, and I think I've found that one. Thank you for producing incredible content that's timely, relevant, and interesting. I'll be recommending your podcast to a lot of people. Love it. Love that those comments, Mary.
Well, thank you, Mary.
Yeah, thank you very much, Mary. Stephen, we've got kind of a more 30,000-foot view discussion today, though. I think listeners are going to find it to be pretty fascinating because we don't cover a lot of the build-to-rent market.
And that's become a huge part of what's going on in Florida now, and people are doing it differently. And so the guest we have today is really well qualified and will give us some interesting insights.
Yeah, I mean, it's tough, right? I have investment properties, and I probably get text messages. And have I said this before, Stephen? I hate text messages. If you send me text messages about trying to buy my property, I will block you. I hate them. This is like going to a framer and grabbing the hammer and saying, let me use your hammer for a minute because I want to show you something. No, I don't want you to use my hammer. I'm in the middle of framing. Don't mess with me. So, I mean, when I get 3 or 4 of these text messages, it's very intrusive. I won't do business with you. Email, on the other hand, I have a chance to absorb some of that. That's a great way to do it. But I think the point of what I'm trying to say is that it's hard for you guys because some people don't like email. Some people don't like telephone calls. Some people don't like, the text messages. And it's tough. And I know I get 4 or 5 text messages a week. So trying to climb, there's investors climbing all over each other, trying to get an increasingly shrinking deal pool. And so when you get someone who's doing a build to rent, they're able to buy the tract of land and then build multiple units. They're able to knock down 10 of them at a time, 20, 30 of them at a time. And they're able to build their investment portfolio that way.
Hundreds, like 150 to 400 homes is pretty huge.
Yeah. I mean, certainly the institutional level guys, BlackRock and whatnot, that's what they're doing. But this guy's more of a local guy, and he works here in the state, knows the state really well, and he's going to talk about the markets that he's working in the build to rent. He's a wealth of information. So I don't want to give away all the top hints that he's giving. So, Stephen, unless you have something else, we'll go ahead and roll right into our guest.
Let's roll in and talk to Doug. Today we have with us Doug Faron. Doug is a co-founder and managing partner at Shoreham Capital. He is a real estate leader and skilled deal maker specializing in sourcing, capitalizing, structuring, and executing debt and equity transactions throughout the United States. Doug oversees all aspects of his firm, including the acquisition, capitalization, development, and management of their projects. Prior to Shoreham, Doug spent 10 years at the Sim Group, a $35 billion assets under management real estate private equity firm, where he worked as managing director. Doug graduated from Brown University with a dual concentration in international relations and economics, and received his MBA from Northwestern University's Kellogg School of Management. He lives in Palm Beach, Florida, with his wife and 2 children. Doug, welcome to the Invest Florida show.
Thank you so much. Very happy to be here.
Hey, Doug, we really appreciate the time that you're investing with Stephen and I today. Why don't you tell us a little bit about your start and a little bit about Shoreham, like, how you got into this side of the business and sort of what your vision is?
Sure. No, thanks very much. So, I spent, most of my career in the institutional investment space. So first investment banking and then corporate private equity. And then the last 10 years at CIM working in the real estate private equity world. And, I've invested across a variety of companies and then, real estate assets, everything from apartment buildings, hotels, office, data centers, industrial, and had switched really from corporate to real estate private equity with one of the motivations being I had a desire to do something entrepreneurial, and I saw more opportunity to do so in the real estate space and more opportunity to do so at an earlier scale in your career. And so after about 10 years at the firm, I had a great experience at CIM, had a wonderful relationship with the owners, was really running the East Coast business and overseeing the investment team, but I wanted to try and see if I could hang a shingle, do it on my own. And in doing that, I was looking for a thesis and sort of what to anchor that business as opposed to just going out and being one other real estate investor. At the time, this is really 2020, 2021, multifamily on its own was, becoming pretty aggressive. We're seeing cap rates in the 2.5 to 3.5 range. That wasn't, really compelling. I didn't see that other than, interest rates going negative, that working in the long term. But at the same time, I was trying to build out new verticals for CIM. And within that, one of the things we'd spent a lot of time on, I had the group do a white paper on, was single family rental and build to rent. And so looking at that space, I saw this interesting confluence of demographics, economic growth, shifts in behavior, and capital flows that to me looked almost like industrial 10 years ago. And on a relative basis, there were a lot fewer sponsors that knew how to do this space properly and put together capitalization, home construction, which is different than multifamily construction, and operations. And so I mentioned that to a friend who's now become my partner, Steve Figari, and who's a developer at Slade Property Group, had been one of the original partners, had built the business in New York for a long time. And he said, my best friend growing up is a sizable home builder in New York and Florida. So Steve introduced me to Nick. We all sat down, and Nick, who built on his own this major home building business, immediately got the opportunity on the build to rent space, was willing to sort of shift. He wanted to diversify what he was doing and then contribute some of his projects on the build to rent side. So, we then went out to some relationships on the family office side to help us on the GP capitalization front and, put together what now became Shoreham Capital. And really the anchor and the target of the business was to grow eventually, a diversified real estate investment firm, but today focused really on the residential space. And within residential, not only traditional multifamily, both ground up and value add, but also this alternatives vertical, which, a good portion of which will be built to rent.
And which areas were you focusing on doing your build to rent?
Sure. So historically, I looked at opportunities up and down the East Coast and really across the country when I was back when I was at CIM. I had, spent a lot of time in the Southeast, the Mid-Atlantic and Southeast. And for a long time, we'd seen there was sort of this mantra of, high quality of life, low cost of living, low tax. And that was pre-COVID that we'd seen that thesis happen and really been investing behind that before. I think, as everyone here knows, post-COVID, that's been accelerated with, jet fuel. So we've seen this massive population shift in the state. You're finally seeing like real employment shift so that you have the opportunity down here to have, higher paying jobs, sort of new sort of opportunities. And so at Shoreham, we saw that and thought, on the residential side, having that as a backdrop, perfect place to headquarter the business, perfect place to be focused in terms of what we're building. So to date, the majority of our projects are in Florida. We're building across the state and are really excited about the growth dynamics, despite the near-term headwinds for the next 5 to 10 years.
So at CIM, you're responsible for a lot of asset classes, pretty much all the asset classes, right?
That's correct.
And so you decided to focus on just residential with your current group, Shoreham. Can you kind of give us an overview of what led you to that decision, and also where the other asset classes are in terms of the cycle that you believe they are?
Sure. I mean, I think it was a confluence of a few things. Sort of one, sort of like, it's like interest and aptitude. I thought multifamily was super interesting. I had worked a ton on it at CIM and done, a portfolio of about 7,000 units while I was there. And so knew the asset class well, knew residential well. But also, I mean, part of the reason for that was, I had the option of doing deals across all these asset classes and looking at risk adjusted return. It's one of the most compelling spaces out there. And, it's interesting, 10, 12 years ago, there were 8 cap multifamily deals. And for a long time, multifamily was trading wider than office, wider than retail, and, which never really made sense to me. But I think over time, it compressed and compressed and compressed until you were sort of seeing it, appropriately priced and probably aggressively priced. I think with anchoring a new business, part of it is where we sit in the cycle and the future I see for sort of residential, coupled with sort of that backdrop and experience in it. I think in starting a new business, we wanted to, real estate investment is all about risk-adjusted return and anchoring yourself with great deals that are, good opportunities. It's not venture. You're not going to do 8 multiple deals. It's, 1.5 to 2.5. And if you keep it in that range, you're a very, very successful real estate firm. So multifamily, to me, was the best place to start that business. You asked about other asset classes. I mean, we spent time at CIM, certainly in office and retail, in hotels, and, they each have sort of their own story. I mean, the hotel business really is an incredibly operationally intensive business. You want to be partnering, or you want to be operating with best in class operators. You want to constantly be evolving, but it's also an asset class that sort of kicks up the quickest and falls down the quickest, given sort of your day over day rents. So you like hotel, but it's really, to me, much higher on the risk spectrum. You want to be highly operationally intensive, and you got to buy when things are terrible and sell when things are great, which is a much harder sort of window to hit. Office over the last 10 years, I mean, I think, there's a lot of people looking around and going, and no one could have called COVID and the sort of rapid acceleration and the impact it had to office. But what you could say is you could look back and go, I mean, for a long time, a lot of these cities, DC was probably 20% vacant pre-COVID, maybe more. New York City, the metrics would say it was 90% occupied, but really, when you looked at WeWork, who is, and as it implodes today, I mean, it was gobbling up space. All of their purchasing people were, or leasing people, the folks that were doing these big deals, were incentivized by volume alone, nothing else, no performance metrics. So they had 10% of New York City at their peak, and I don't know, was that 2 or 20 or 30% occupied? So I mean, looking at it truly, all these markets were low to mid 80s occupied, and worse than that, I probably real estate private equity partially to blame. The game had become give massive TIs to buy up rents to sell to the next guy. And that became this unsustainable game where in some cities you'd do like a 5-year deal with $150 TIs at net $15 rents, which is illogical. So to me, all of these things had massive headwinds, retail as well, just, a lot of change in e-commerce. Industrial was interesting. I think that was a great space, but crowded. There's a ton of people there. So to me, this anchor of residential, which was an asset class I knew really well, and focused around this like sort of newly emerging vertical, which, we can talk about more, is what the growth dynamics in that space are incredible. And all it takes is small adjustments in home ownership nationally, from that like 66 historical to 64 to 63 to 62, and this sort of institutionalization of the build to rent sector. There's massive tailwinds for growth.
Talk to us a little bit about Florida. It's going through some pretty significant changes. The pricing is the one thing that it's gone through the roof. I think one of my clients referred to it as a nuclear bomb on crack. I mean, really what's happened since COVID. And so when you start looking at numbers, and me as a former banker, I always look at how sustainable are these rent increases in this, and are we priced for perfection, and what happens if you start seeing communities like Metro-Dade, Hillsborough County, the greater Tampa Bay area, where household income is now rent is more than 50% of household income. And that's gross. So you're looking at it and going, wow, I mean, how are some of these folks surviving with rent? So having said that, what are you seeing, and where do you see the future headed?
Yeah, and Doug, just before you answer that, but along the same lines, I was speaking to a client today who acquires throughout the country, and he said he's seeing price declines in other markets, but he's not seeing it in Florida. And so we had a little discussion about that. So I think that's relative to what you're going to talk about now.
No, I think it's interesting, and price declines, I mean, across a number of sectors, right? So price declines across, sort of the, transaction market for sure, but also, you're seeing a similar phenomenon on construction costs. So construction costs remain elevated in Florida, where in other markets they're coming off. And so the whole state is really white hot. And I'm not saying it's unimpacted. You're certainly seeing in some markets stabilization on the for sale, or in some markets on the rental side, you're seeing some tapering, but nowhere near what you're seeing in other places. I think you raise a good point relative to sort of incomes and what can be afforded. And I think there's sort of a couple of pieces to that, because I spent a lot of time in the Mid-Atlantic, for example, doing multifamily. Take sort of simple example, someone paying $1,400 a month in rent. In DC, you'd have folks that were paying $1,400 a rent, and they were making $50,000 to $60,000 a year. And again, super high percentage of income, but to be in that location, say in Alexandria, outside of DC, where those jobs were, that was what they were willing to do. We would see projects in Orlando and in Tampa and other parts of the state where that $1,400 rent, the average in-place income or median income in a property would be $80,000 or $100,000. And then that $1,400 would go to $1,800. And it was a massive, especially this was beginning of COVID, you see these massive increases. You go, oh man, that's crazy. But at the same time, still less as a percentage of income. And as you go up in the income scale, it's more meaningful. At the lower income, every dollar matters. So I think there was room in the beginning, but you've seen this massive increase and this, sort of sustained increase. On the other hand, you've also seen this massive influx of new employment and new jobs into Florida. And so the answer may be in the near term, you see this sort of like overturned situation where it's a high percentage of median income. But some of these new jobs that are filling some of the new office space that's being developed. I mean, for example, West Palm Beach is a great example where you had, effectively $1 million Class A office market that's now basically $2 million. Related's played a huge role in that, of course, but that new million feet's, somewhere between 50 and 60% pre-leased. So you've got 500 to 650,000 feet of office that is pre-leased, and all of those numbers on those leases are the highest this market's seen ever. So you got to expect that someone leasing that space is putting a higher paid worker in that space. None of them are here yet because all of that's in construction. But over the next 1, 2, 3, 5 years, you would expect that a lot of those folks will arrive because you're still seeing net influx into the state, into some of these centers. So it can't be true everywhere, but in some of these strong markets where you're seeing this new employment happening, I think that may right size by more higher income jobs coming in. Not true everywhere, not true in every market, but there are some places where I think it can sustain. You got to pick your spots accordingly.
It's interesting because people talk about the commercial real estate market, and I say, what's that? Because there's no such thing as a commercial real estate market. It's hyper local and it's asset specific. So even the office market, people say to me, what's the office market? It must be terrible in Tampa. And I say, what's the office market? I don't know what that means. The office market in Tampa. Well, downtown is Tampa, and in your cores is really strong. It's like historically strong. So when people say, well, no one's going into an office, it's like, where are they not going into an office? In the suburbs, on the other hand, when you get into your class Bs and Cs that are in your commuter space, those places are taking a beating. And you go out around, the I-4 and the 301 corridor in Tampa, and you're looking at, there's 40, 50% vacant. But then you go to downtown Tampa and it's not. So it's a real dichotomy. It's bifurcated, the market between the haves and the haves not, even in the office space. So it's not really specific. And you're in South Florida. Are you kind of seeing the same thing in South Florida?
Well, yeah, and look, we spend a lot of time across the state, so we do a lot of we spend a lot of time on Tampa, but I think as you described, and again, Florida versus the rest of the country. I mean, the rest of the country, even downtowns, are having this sort of massive reset where there's just less office demand, and eventually it will catch up. But some of this outdated office space, it doesn't matter. I mean, even when that demand catches up, it needs to be completely remodeled or torn down. So those are larger issues to deal with. In Florida, you sort of have this fortunate moment where there's been so much growth that the office space that exists is being used, and especially like you said, you take suburban versus downtown. I mean, downtown Tampa, the project that Cascade and Vinnick are doing is
Water
amazing.
Street.
Yeah, Water Street. I mean, they've been working on that, and they had $3 billion into that project before COVID. And that 100 Water Street office building, which is beautiful, and that whole area, that whole development is like Hudson Yards South. It's amazing, but it was 0% leased going to COVID. They launched it recently, but it was not really getting traction. But today, I think 100 Water Street is fully leased. They're building more office downtown. There's the TPA projects that were leased and sold, and you had Pfizer come in there by Armature Works. I mean, you've seen and you've seen like this urbanization in Tampa where people are really accepting the downtown. It took a long time. I've been going to Tampa for 20 years, and like Channel Side Water Street was literally parking lots. So it's amazing how much has changed. But now you have people from all over the country that move there that want to live in an urban environment. And Tampa has all those things to offer. It's great retail, great restaurants, this office high-rise downtown core. So, I mean, I'm very bullish on that place for a long time. And like you said, I think those are the winners. I think the suburban areas, even the suburban areas, I mean, West Shore is really a suburban office market that's always sort of led Tampa. That still seems strong. I think you'll probably see more shift to the downtown from there, but West Shore still, just because of its proximity to sort of various population.
Yeah, access to employees. Yeah,
exactly.
access to employees.
It's actually a bigger office market right now than downtown.
Than downtown.
Oh, for sure.
Yeah.
Oh, for sure. It was always a preeminent office market, and downtown was sort of secondary, but I think they're starting, and I think they'll move towards one another. But yeah, the further out suburban office, I mean, look, in a lot of other markets, that's scary. In Florida, I'd say great development site, like for residential. So I think a lot of those sites are being seen as, let's look at what the, sort of remaining lease term is, and, can that parking lot be redeveloped as multifamily for all this growth you're seeing in the state?
Yeah, and that's the thing. There was the conversation with the movement of retail online, and it affected most the malls. And everybody, again, people say the retail market's terrible. What retail market are you talking about? Because I don't know what you're talking about. If you want to talk about malls, yes. Big box, yes. But your strip retail, they're not going to serve ice cream by Amazon. You're not getting your hair cut by Amazon. You're not getting groceries are always going to be something that someone goes and picks out because they want to pick out their fruits and vegetables. So that's not going away. And as long as you've got 45,000 cars driving in front of that location, it's always going to be vibrant. So I don't, you have to classify when you talk about these markets, what are you really specifically meaning? Because it can be a lot of things going on in each side of each one of the asset classes. If you look at the malls, like in Tampa, and I know this is the same thing in South Florida, the West Shore Mall, is there a better residential site on the planet than West Shore flipping Mall? I would knock that sucker down and just build friggin' residential and walking retail. I would blow that thing out with residential because I don't think there's a better location. So, would you guys get involved in something like that, like a rework, or are you just going to do single family, the home builds? Or talk to us a little bit more about what you do in that regard before you make comments on the whole like mall conversion type of thing.
Sure. No, I mean, we look, more broadly, and I think we have a residential focus, but that residential focus is divided into a bunch of different things. It's ground up multifamily, it's value add multifamily, it's, alternatives, which, might be senior housing, student housing, and a lot of the single family rental, which, and build to rent specifically, which we're really interested in. And then also adaptive reuse, which, you might look at for a downtown office building. I think it also applies to sort of how you deal with some of these retail assets. And I agree with you. I think it's a great opportunity as a real estate investor because the baby is often thrown out with the bathwater. So like people just wouldn't touch retail. But when you dove in, as you said, to grocery anchored retail that's well located, that did really well. And it was trading at really wide yields just because your large institutional investors were like, well, we're just not touching retail. But okay, but then you found these assets that were performing and going to continue to perform, you could buy them really well. Sort of same story in this office world. If people are just not touching office or suburban office, but that suburban office is on a 20-acre campus that can be easily redeveloped in that submarket in a good multifamily location, terrific. If that, West Shore Mall, by the way, it helps the retail anchor if you build, multifamily above it. I think the trick with malls is you often have, a Macy's or a group like that has these drag rights. They know exactly what they have and they utilize them to extract every dollar and slow you up. So I think you have to be careful with redevelopment on some of those parcels accordingly. But when you've got, a clean site and a municipality that wants to see it changed, I think there's great opportunity there. So we like all these different we like mixed use deals, and we like something a little bit of hair that other people won't necessarily, look at. So you got less folks combing over it to find a better deal.
So you were talking about build to rent as your focus right now. So you'll develop, but you're not selling. And then what do you look to as a holding period?
Sure. I think the answer to that question can vary. And I think like SFR, BTR, just to sort of anchor ourselves in what we're talking about. We're not, at least today, we're not focused on buying, scattered single family homes that exist. I think that's a aggregation play that requires a lot of technology, a lot of scale, and really a different game. What we're interested today is, and also much more difficult to capitalize these days. What we're interested in is build to rent, which is, it can be single parcel, multiple parcel, but it's contiguous. It's a community that's, call it 150 to 400 homes. It really looks a lot like multifamily. It's usually amenitized. It has, on-site leasing, on-site management. And to us, it's sort of the natural next step because a lot of folks like living in these communities where they get outsized amenities and the outsized experience because they're sharing the cost of that gym, pool, dog park across the 400 other units in the community. And instead of putting that down payment down, today, your option is usually in these communities either having, a studio apartment, a 1-bedroom apartment, a 2-bedroom apartment, or maybe a 3-bedroom apartment. We think, why wouldn't we offer all those same amenities to a townhome with a garage and a backyard, a detached 3 and 4-bedroom home with a garage and a backyard? These are things that, I got a 5 and a 7-year-old. I certainly know that having kids, having both a garage and a backyard are highly valuable. So we're just offering a product type to both the millennial generation, which is aging later into, sort of childbearing years, and also the baby boom generation, which is maybe tapping the equity in their home and downsizing into something on the rental side to be able to use that equity to live off of. So that's some of those demographics that we were looking at going into this and said, wow, there's a lot of people that might be attracted to this product if you build it for them.
Where are you seeing the cost per square foot now to build some of these communities? Because there's been because construction costs just kept going up and up.
I think that's exactly right. I think, pre-COVID, you might have been able to build just on a simple hard cost number on a single family home, $75, $80 a foot in a lot of places throughout Florida. Today, that number is anywhere from 110 to 125 to 150. And that's for pretty entry level. We're not talking about, high end. This is just sort of entry level homes and more affordable parts of the state. So, those numbers have crept up significantly. And, like we talked about earlier, the construction costs remaining high in Florida has been the real challenge because we've seen cost of capital move up massively, right? Capital went from sort of 2% to 7% in cost. And so against that, you need construction costs to change, or it doesn't matter what the land goes on sale for, you can't build it. We've seen some capitulation in land costs, but it doesn't really matter if, it went from $40,000 a door to $20,000 a door, but the total cost to build a house is $300,000. It's still uneconomic if your cost of capital has changed that much. So we need to see, a decrease in construction costs and growth in rents to really make building more housing feasible.
Of course, insurance didn't help you either, right?
And that's the other fun leg of the stool these days, which is insurance has crept up, and that is a whole topic we can talk on its own. There's a variety of reasons in Florida specifically that it's gone up so quickly. And I mean, let's all keep our fingers crossed for a softer hurricane season, storm season, because if we don't have that, this could be more of a prolonged raise, which is really problematic.
I feel like even mentioning hurricanes, it's like watching Beetlejuice. Don't say it more than 1 or 2 times because Beetlejuice might come out.
I think you're exactly right. Well,
and I'm going to throw further jinx on them. We've had this El Nino thing that's out here this season that's been, shearing these storms. The flipping Gulf's 100 degrees right now. I know that in Florida Bay, it's 102 degrees. Oh my gosh. I'm just like, keep that wind shear going because I can't even imagine if one of these storms came into the Gulf this year. But I'm not going to say it again because the third time is going to be is when Beetlejuice is going to come out.
I agree with you.
Let's talk a little bit about the areas of the state that you like and maybe ones that you're a little uncomfortable with right now.
Sure. I mean, I think there's a lot of dynamics that are very positive. I mean, growth is great across the state. I think looking on a relative basis, we really like Southwest Florida. And what I define that as is everything from Tampa, almost all the way down to Naples. So Tampa, Sarasota, St. Pete, Port Charlotte, Cape Coral, Fort Myers, Naples, all of these markets have tremendous growth. They benefit from, great airlift, great airports, a much more affordable base. I mean, you think about South Florida, it's very expensive relative to these markets. And these other markets still have a great quality, amazing quality of life, the same tax treatment, and it's just cheaper. So we think, and the data will tell you, there's much more projected rent growth in Southwest Florida than in South Florida, which still has good rent growth. Maybe it's 2.5, 3.5. Southwest Florida is 6 to 10%, depending on where you are. I think that the Panhandle and Jacksonville probably trailing behind. I mean, still great growth, but not some of those same entities, not some of the same employment growth and things we like to see. And also just like, baseline rents, especially when the build to rent space, just not high enough to justify construction when construction costs across the state may be different, but not that different. So you really need a certain base level of rent for it to make sense.
Do you see any reprieve at all on the construction costs in the state of Florida? Because as you say, I'm looking at lumber at Home Depot, and you're looking at these commodity pricing, and you're saying it's falling. Why is it not happening in Florida? And what's got to happen in Florida for that to occur?
Well, I mean, also depending on where you are, but there's still a lot of repair work going on in Cape Coral and Fort Myers right now. So that that need for construction materials is still up. There's still a lot of construction happening. Now less. You're certainly seeing it come off some of the supply. And I think the good news is you're seeing a tapering. I mean, for a long time, you're seeing these crazy increases, from 2020, mid-2020 on. And I think those crazy increases have stopped. So you've sort of stabilized. But as to whether you're seeing declines, you haven't quite seen them yet. You're seeing, subs reach out and be more active to GCs looking for more work. That should drive down costs. And I think as, the cost of capital makes development much harder for a lot of different projects, just simple supply demand, like less stuff being built, less demand for materials, less demand for labor, all that should happen. We haven't quite seen it yet. We do think it will. But, that fun thing in Florida is that, if you have a bad storm you have to repair after, that'll drive the cost right back up again.
Have you guys done any analysis at all on this Biden infrastructure plan? And how much? Because we have clients I have clients that are on projects in Florida as a result of, and I'm just curious if you've done any research on how much resources is in the state of Florida is that taking up, which could also be aggravating the prices for construction, certainly for labor, I think.
Yeah, I mean, I think it is certainly having an impact. I think how to quantify exactly what that is, I'm not sure, but that it's going to. Again, more demand for construction. That means costs stay higher longer. So we'll see how that pans out. I think on the positive legislative side, we're watching this Live Local Florida Act come out, and we think that's going to be interesting for some of its dynamics and ability to develop more housing in the state. So we're looking for that to sort of be finalized and usable. But I think there's some stuff that's helpful. But yeah, I think more construction happening is going to keep costs elevated. It's the reality.
I asked you a 2-part question. I think I got the answer. I just want to make sure when I asked about Were there areas that you liked and maybe some areas you're a little cautious of? And you mentioned that South Florida and the costs in South Florida. Is that your answer in terms of like areas that you're a little bit maybe cautious on?
Well, what I'd say about South Florida is, to your first point about affordability, it is very, very expensive. And it's very, very expensive across a large swath of area. And it's very developed. And there's some hurdles to redevelopment in a lot of those areas. So and then you add to that, there's a shadow supply of investment in South Florida of just capital from other countries, being parked. And so, to really look through to like true utilization, supply demand has always been hard because whatever your multifamily supply, you've also got this shadow condo inventory. And so, the net result in the data is that sort of lower projected growth rate of like 2.5 to 3.5 versus 6 to 9. I think it's also just like how much, and you're seeing great growth in Brickell and downtown coming up and, Coral Gables to an extent. So you're seeing some of that employment growth, but not quite as much and not as much on a relative basis because you have a larger base than to other parts of Florida. So I'm positive on, South Florida. I'm probably I think there's more growth in other areas, which is where we spend.
Are there any areas which you feel less optimistic about? And, also Jacksonville, a lot of people were saying is going to continue to be a strong area.
Yeah. And just to finish the point on South Florida, I'd say not only is there sort of less growth, but it's very well watched. Everyone outside of Florida, the first thing they think about Florida is really, other than Disney World, but from an investment perspective, a lot of large institutions know Miami. So every deal in that market is going to be sort of more combed over. Some of these other markets a little bit less known, which we think provides better yield. Jacksonville, I agree, I think has that same airlift benefit, great quality of life on the water, lower base. I don't know that we're watching to see if the employment growth there sort of ticks up in the same way as Tampa and these other MSAs. So I think that's what it needs to really elevate median incomes and, have rents grow. So I think there's great growth there. We're just watching to see, when that happens and, can we be a part of that?
Tell us a little bit about your capital stack right now. Obviously, we're having, I think it's unprecedented, right? The rate of increase. Of course, we've coming, as you say, from 2%. And it's been very, very dramatic in a very short period of time. So tell us what your capital stack is looking like right now.
Sure. Naturally, when your cost of capital goes from 2.5 to 7, you have lots of implications. And just looking at the risk-free rate, right? We're at a risk-free rate that's 4.5% plus or minus to 5, depending on what you're looking at. And so, from an asset class that was trading, as we talked about in the beginning, at 2.5%, 3%, 3.5%. That certainly doesn't work. And you've seen the result of that, which is these assets that some people bought for 3.5% can't trade for less than 4.5%. That's the risk-free rate. So, are they worth 5 caps? Probably not. 5.5, maybe. Is it 5.25, 5.75? Depending on where it is, what it is. So that's the near-term impact. Now, will rates be this high forever? I don't know. Will they come down soon? Do I think the forward curve is exactly right? Probably not. Do I know exactly how fast they come on? Absolutely not. If I did, we should be doing something else. But I think, regardless, you've seen this big change. Your base rate is up. And so the question in real estate always is, what's the proper spread to the risk-free rate? Like where should cap rates be relative to the risk-free rate? And where should your yields be relative to cap rates? So for us, it just makes it much harder to find those deals. This confluence of higher construction costs, higher cap rates, higher cost of capital means it's that much harder to find a deal. The good news is, if you sort of stay focused, you have sort of, good growth behind your thesis and you find those great deals and they work in this environment, if the world just gets a little bit better, and I don't know that we're at the worst point in the market, but I also don't think we're at the best. So if things just get a little bit better and you're able to sort of deploy in this environment, and that's really our goal as real estate investors, is to find the best opportunities in any environment, I think, you can do well. And, we're not going to blindly put out money just to do deals, but we're trying to find things that are super compelling against a very conservative backdrop. And if that backdrop is just a little bit better, we think we deliver amazing returns for our investors. If it stays as it is, all of these deals pencils and are great returns for our investors. So that's the game, is to find the deals that make sense in the current environment.
Well, it's certainly helpful to be at least in an area where people keep moving down, and it looks like it'll continue.
That's absolutely key. I think the backdrop of, and we focus like most on what's your untrended return on cost, what's your yield based on what you're buying, based on what you're building, based on where rents are today. But everything we do in a market that has growth, right? We wouldn't do any of these deals in a market that we don't think has great growth. So the hope is that you're surprised the upside on your growth and that everything worked on an untrended basis, but growth really makes it happen.
Doug, it's really been a pleasure having you on the show. If there's if folks want to get in touch with you, because you have opportunities for investors. You work with family offices quite a bit, correct?
Yeah, absolutely. I mean, we have opportunities on that front. So
brokers bringing you deals.
Yeah, I mean, we would love to be seeing as much deal flow and folks that want to get involved and become investors of ours. We're happy to connect with. So easiest way to reach me is email Doug@shorehamcapital.com.
And we'll have that in the show notes. Stephen, before we let Doug go, is there anything else that you'd like to cover with him?
Yeah, so I was just curious now, like you're going on a more concentrated approach to build to rent. What do you see about some of these hedge funds and that were doing the more scattered approach? As long as it was residential, they were ready to eat it.
Yeah, to me, I do think that broadly there's great growth in the residential market, and there's a reason these guys, from a data perspective, are investing this way. I think that this scattered home play again requires a lot of technology, and it makes management much more difficult. And your debt cost of capital in this environment is much higher. So if they're well capitalized to do that, if they can buy them at the high enough yields to do so, I think that can make sense for them. I think you also face a lot of regulatory and sort of pushback from local communities in that asset class. I mean, we're here trying to provide more housing. We're trying to build more housing, provide more houses for folks to live in. So we think that's received very favorably. I think there's a lot more pushback on the other side. And, after investing in markets like New York, where you get a lot of pushback politically, it's much easier to invest in a place like Florida where people are happy to have you and want you to grow. And we're trying to invest in the build to rent sector, which we think has good tailwinds and good acceptance from a lot of the communities around the state.
Yeah, and land's a challenge, right? But it's not nearly as much of a challenge as trying to buy one-off single-family homes. I mean, I get probably 10 text messages a week from people trying to buy my properties. It's like, man,
it's 100%. And I think, by virtue of it, you're probably to buy these individual assets, you're probably overpaying in the current market, and you have to have a bet in the long term. That bet's got to bear out. The way we're going about these investments is we're looking at sites that are penciling in the current environment. We're trying to buy the land well, develop well, and have it be good today. And if that same growth that helps the guy that's betting on the scattered single family applies to us, which it should, then it's sort of an even better outcome.
So if someone was bringing you a deal, like where would land? What would the cost per door need to be on some?
Yeah, that was my next question. I guess it really depends on whether it's a single family home or it's a multifamily or whatever. But I'm interested to hear the answer.
So you're exactly right. It depends on what is the asset you're building. Is it a multifamily door? Is it a studio 1-bedroom, 2-bedroom door? Is it a detached 3- and 4-bedroom house? Is it a townhome? And then obviously, second of all, is where's the geography? Is it downtown Tampa? Is it an hour south of Lakeland? Where are you in the state? What are rents in that environment? And accordingly, you back into cost to build, which again varies, but varies less. So harder it is to find land, the easier it is to make these developments work. So that cost of land can vary immensely, but we try and focus on, what we call infill, built to rent locations. So it's not infill on the multifamily side. That's a much more core location, but a built to rent on the core location is probably a 20 to 30 minute drive from a major employment center. It's serviced by great schools and good retail. So we're looking for those great locations. And then in those locations are more likely to be able to pay more per developable home in those locations.
Are there any communities, municipalities that are a struggle for you because of impact fees and or permitting?
They exist in sort of across the state. Some are easier, some are harder. And it's I think they have to keep an eye on the impact fees and how much they're charging, because are they discouraging development when they really need it? And they can be creating a housing shortage for themselves. So across Orlando, across Tampa, across Jacksonville, you see a wide variety of these things, but it's not stopping us from being in those environments, but it's just changing the cost of land and again, whether we'll build that site or choose to be somewhere else in the state.
Awesome. Stephen? Are we done with Doug now? Can you let him go? He's like, he looks very hungry.
I just enjoyed listening to it. So we appreciate you being on the show, and we look forward to tracking you and seeing what you're doing.
My pleasure, guys. Thanks so much for having me. Look forward to catching up soon.
We appreciate it, Doug. And that was Doug Faron with Shoreham Capital. What were your takeaways, Stephen?
So I thought that Doug was really astute in just his investing philosophy. He's not like some of the that investors that just accumulate cash and want to deploy it. I mean, he's looking at the risk-free rate of 4.5% and saying, hey, if we can't do better than what's out there in the market and make an investment work for our investors, we're going to pass on it. It has to make sense. And he's looking at all the things like geography and rent growth, and a deal has to make sense.
Well, he's a wealth of information on Florida data. And so it was great to be able to talk with someone like that has so much knowledge, not just about his area of South Florida, but he knows Tampa well and Orlando well and Southwest Florida. He's really bullish on Southwest Florida, as he discussed. And so it's great to be able to have those types of folks on the show. And maybe it also might broaden some of the listeners' perspectives of, instead of mano a mano trying to find single-family homes to buy, to invest in, fix and flip or whatever, that you go outside of that box and try to find deals that might need to be, let's say, tear downs, and you put multiple units back up into them, or buy land and do the build to rent. So it was an interesting conversation. He has a different perspective, I think, than most investors in residential trying to find deals. But Stephen, Doug was a great guest. Where can we find other great guests?
The place to go is you can go to our website, www.investfloridashow.com. We go back a lot of years now, and we've got a wealth of really great guests that you can listen to, and also download the app so you can listen while you're mobile in the gym or driving somewhere.
Guys, as always, we appreciate the time that you invest with us each and every episode. And until next time, hasta la vista.
You've just listened to the Invest Florida podcast with Eric Odom and Stephen Silverman. Join us every week for actionable real estate investment ideas, and of course, visit our website at www.investfloridashow.com for more shows and tips on how to earn a cash flow in the real estate market in Florida. While hosts and producers of the Invest Florida show have no reason to doubt the validity of comments of our guests, we do not warranty their accuracy. Please check with your legal, financial, and tax advisors before entering into any investment. Returns will vary from person to person and deal to deal based on unique circumstances. All information expressed in this show is for educational purposes only. Opinions of the guests are not necessarily shared by the hosts and producers of the Invest Florida show.